and a warm good afternoon. You're watching Business Plus. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. First up, we'll begin with markets. Markets opened at an all-time high. Both Sensex and Nifty saw bulls run on Dalal Street this morning. Does the momentum continue?
The momentum did continue throughout the session, Shweta, and as a matter of fact, Nifty also ended at all-time high levels, at all-time high closing levels. Now, after opening in the green, as you mentioned, and scaling record peaks in the opening trade, the markets remained in the positive territory for the majority of the session, and Nifty, the 50-share index, climbed a lifetime high of 20,222. So, Nifty has surpassed what a lot of analysts were saying will be a resistance in the very near term. Nifty was able to surpass that and closed just marginally below that, Shweta. Right. It closed about 20,192 levels. Also, Sensex climbed nearly 67,900 levels. It was up about 300 points in the trade today. Another thing that we also need to mention is the mid-cap and the small-cap indices. The small-cap and the mid-cap indices, which have been outperformers for the last 6-7 months or so, at least since the start of the financial year, underperformed the market in today's segment. Nifty Midcap 100 was up about 0.28%. At close, Small Cap 100 was up about 0.4%. Another thing which will augur well for the bull, Shweta, is that India VIX, the volatility index, which gives us cues about what the current volatility in the market is as opposed to the last 30 days, dropped by about 4% and is significantly below the 12 mark. It closed at about 10.86. So that is how the markets went, Shweta.
All right, so markets looking good there. Nifty up 0.44%, Sensex 0.47%. In fact, the rally has been on and continuing for a while now, and we've been speaking to various experts. We're hoping to get Rahul Arora very, very shortly with us on the show. But before we do that, I also want to know some of the sectors that you're tracking today.
Yes, Shweta. So in today's trade, the auto sector was the biggest gainer. It was up about over 1.5%. Another sector which was among the top gainers in today's trade was the Nifty IT pack. It gained about 1% in today's trade. On the other hand, FMCG, metal pack and media stocks ended today's session in the red. They were under pressure. FMCG, as we know, has been under pressure for quite a bit now for the last 3 or 4 sessions. But talking about gainer, Shweta, Nifty Auto, which there were some troubles we saw earlier in this week when there were comments that perhaps the government could look to increase tax on diesel vehicles. Now Mr. Gadkari clarified that nothing is in works as of now. The Nifty Auto pack bounced back from yesterday's session, and it was up about 1.6% in today's trade, with a lot of stocks hitting their 52-week highs, Shweta. If you look at the Nifty pack, stocks like TVS Motors hit a 52-week high, Bajaj Auto hit a 52-week high, and there were other couple of Mahindra & Mahindra was another stock which hit a 52-week high. And it seems that the current push that we are seeing in the auto sector is coming from the two-wheeler stocks. Now as we know, two-wheeler stocks have been under pressure. They were under pressure because of inflation concerns and sluggish demand from the rural market, but we are seeing green shoots of recovery in that segment. Demand is picking up once again, and a lot of brokerages are sharing positive views about the auto pack. In fact, about the two-wheeler pack. In fact, today itself, BofA Securities has recommended a buy rating. Earlier, it had a neutral rating. It has also raised the target price on Bajaj Auto, as it expects that there are multiple levers for growth for the company. It now has a target price of about 5,550 as opposed to 5,100 which was earlier. Other stocks such as Tata Motors, Mahindra & Mahindra, Hero MotoCorp, all were up about 2% in today's trade.
All right, all of them up about 2%. I mean, look at the rally in auto stocks, multiple triggers there. But more importantly, I think you mentioned, at least for for companies that manufacture diesel vehicles, there is a relief. There is also a relief for, general automobile segment per se, because we also heard Nitin Gadkari, the road transport minister, talking about perhaps the 6 airbag policy, which will not kick in, will not be mandatory anytime soon. A big relief there for a lot of auto companies that were bracing for not just higher input cost, but also hoping to pass on that cost to people. There had to be quite a few changes made, but those changes will not be made anytime soon. So all of that has augured well, those news items have augured well perhaps for the auto segment. And joining us at this point in time is Rahul Arora, CEO of Nirmal Bang, to talk perhaps more about how market is showing this extreme exuberance. We'll come to auto pack in just a bit, Suyash. But Rahul, appreciate you taking time out. Very good to have you on the show. I want to begin by asking you, market's been rallying and rallying like how? What are you making of it? Are the macro data available out there? Are the macro numbers supporting this sort of exuberance?
So good evening and thank you for having me on your show. Look, I think obviously the macros are far better today than they were anticipated to be about 8 or 9 months back. I think the fact that we still haven't entered a global recession is itself a very big positive. I think obviously the negative side is that crude has started to inch up a little bit. It's sort of gone north of 90. And the fact that interest rates, there was some clamor in the market about 3-4 months back that interest rates might come down at some point in this calendar year. I think those expectations have been pulled back. But I think the biggest positive, so to speak, is that globally we haven't entered a slowdown. So I think from a trade deficit standpoint, that should hold us in good stead. But the kind of flows that the domestic mutual funds are seeing, it's quite unprecedented. I think even at 20,000 on the Nifty, some fund managers and CIOs that we speak to are getting about 50 to 100 crores worth of inflows every day. And that's been a bit shocking. And I think till that continues, I think, the market momentum may well continue. As surprising as it is, and valuations are certainly starting to look excessive in many parts of the market. But, I think more than fundamentals, this has been a liquidity-driven rally. And for the foreseeable future, it seems like that may persist.
All right. And are these numbers sustainable for somebody who's looking to enter market at this point in time, perhaps a young investor? Would you recommend them to enter?
That's a very tough call. Let me spin that question around in a different way.
Okay.
If I'm invested, I have no reason to sell. But if I am putting in 100 rupees today, I would think twice. I think, you have a 10-year GSEC that's at 7.2, 7.3%. There are certain debt instruments that are giving you 7.5%, 8%. So if you have other alternatives that are giving you between 7.5%, 8% kind of returns at a 20,000 Nifty, I think the odds are equally favorable over there because, if you're talking about 8% on a 20,000 Nifty, you're talking about another 1,600 points to be going up from here. On current evidence, I'm not sure that can happen. So I think more than stock and sector allocation, I think it's not a bad point in time to look at portfolio allocation. Maybe reduce some exposure to equities, probably nibble a little bit into gold, a little bit into debt, some into GSECs. The primary position will still be equities. I'd still say be 50-60% in equities, but I think other asset classes at this level would be looking equally attractive, if not more. But that being said, like I said, if you are invested, stay invested. But fresh capital at this point, I would be jittery.
Hi Rahul, Suyash. As you said, gold is one of the your recommendations to asset classes to enter at current levels. Although gold has been under pressure at current levels, it is at a 3-week low. So, what are your expectations and outlook on gold? In the very near term.
So, look, I can give it to you from a commodity standpoint as well as from a stock standpoint. I think, we are at the cusp of the festive season and the marriage season, right? Typically, October, November, December is when the bulk of the festivals and marriages in India happen. So, from that point of view, I think the third quarter of this fiscal year will see a huge uptick in demand as far as gold is concerned. Globally, I think if you look at things, when you look at an alternative hedge to equities, gold has been a relatively safe asset class to look at over a period of time. It may not necessarily give you an appreciation, but if things go down, it may not actually go down. So on a relative basis, you may have outperformance. So even if equity, the point I'm trying to make is if a stock goes down 10% and gold still holds on to its level, you still outperform by 10%, even though the absolute level would have gone nowhere. So given the commentary that we've heard from players like Titan, Kalyan Jewelers, TBZ, some of these listed companies, I think the outlook remains extremely strong. The good part is for a lot of these companies, they talk about the fact that the demand for jewelry above 50,000 to a lakh, that demand has not really seen a big hit. The hit for jewelry demand may have come in at the lower end of the strata, say between that 10 to 20, 30,000 price point. But at the upper end on the premiumization, it seems to be doing well. So I think given commentary from the manufacturers themselves that are in this business, given the fact that it could be a reasonable hedge to equities, and if the world indeed does go into a slowdown sometime later this year or early next, it may not be a bad asset class to be investing in. What kind of returns could you get? I think even if you get 10% from here, it may not be a bad trade to make.
All right, not a bad trade to make. But, you know, I also want to pick your brains on small caps and mid caps, because they seem to be the flavor of the season, flavor of the day, bucking the trend, sometime, you know, out rallying the broader markets at large. What are you making of what's leading to this sort of rally in small caps, mid caps? Is it sustainable?
It worries me no end. And the reason I say it worries me is when you typically value a stock, you value it on time and you value it on a price to earnings multiple. Earnings is something that you can't control. What a company reports is what a company reports. At what time frame you want to value it at, that's in your hands. So, you know, you could either value it on FY24, FY25. In fact, a lot of brokers have now gone beyond FY25. Now, the reason that is happening is because a lot of fund managers who are getting the monies that they are essentially buying the same stocks that they have in their portfolio. And this is not, particular to one or two funds. This is fund agnostic. So typically what happens is, you know, if I'm holding company A and I'm getting inflows and I keep buying more of company A, I'm artificially driving the price to earnings ratio of that company higher, which is making it very difficult for brokers to put in a price to earnings multiple on that stock. Now, you know, as these numbers go higher, it gets more and more absurd. So you then start valuing companies on financial year 26. These are all very, you know, hyper bull market kind of terminologies and things that are underpinned by a lot of liquidity. I don't think the earnings growth is supporting these kind of valuations. What you saw happen earlier in this week on one particular day, I wish we had 3-4 more of those days. I still think that there is still a lot of excesses in the mid and small cap. And the fact that you only have 50 or 75, you know, basically the Nifty 50, and then maybe, you know, another 20 or 30 stocks in the large cap space that people really invest in, you know, the incremental flows typically just tend to go into mid and small caps, and that causes a lot of fraud. So I would be a little worried if you ask me to choose by market cap. I think for the next 6 months, the large caps may well outperform the small and mid caps. And I think if you made your money in mid and small caps, actually take some of it off and try and look at industry leaders in the Nifty or the BSE 100 and try and put in some money there. I think the chances of you making money in that trade are far more than being in mid and small caps at this point.
So I just also want to get your view on the auto pack. Now, the auto stocks were some of the best performing stocks today. In fact, if you look at the top 5 gainers in the Nifty pack, 3 of them were auto stocks. And it seems that, after a period of underperformance, the two-wheeler stocks are once again shining. Now, brokerages are saying that their focus on premiumization is going to help. How do you see, two-wheeler stocks performing in the next few months or so?
So it's a great space to be. Again, partly because of the reasons I mentioned. I think typically ahead of a marriage season, you do see, and festives, you do see inventory build up by the dealers and stockists at the ground level. I think even though the monsoons have, I think, on an aggregate been about 10% deficient, I think it's been all right enough from a perspective of not dampening rural demand to a great extent. I think, if you look at two-wheelers, as you very rightly pointed out, you can either look at mass or you can look at premium. While you do have Harley Davidson that's coming through Hero, and I think Bajaj and TVS have also spoken about having bikes in that 250 to 500 cc range. My sense is that Eicher will continue to be the person that will dominate that space. While obviously it will definitely cede some market share. See, remember one thing, the only person who can lose market share is a person who has market share. And sometimes losing market share is not the worst thing in the world when the category itself is growing, right? So you may well be able to claw that market share back if other entrants come in and actually grow the market size for you. We have seen a correction in Eicher's stock post the announcements by Hero, Bajaj and TVS. It looks like an interesting play. I think even if you look at the sub 250 cc segment and compare it to, say, a Bajaj or a Hero or a TVS, Eicher is actually holding its own. I think last many months, I think they've given a CAGR of about 10-11%. in terms of volume growth. At the bottom of the pyramid, I think if you want to play the absolute rural recovery, I think Hero is probably the way to do it because they have, I think, about 50% of the market share in the sub 100cc space. Typically, this is the space that tends to do well around this time of the year, and I think the numbers will show up. I wouldn't be surprised if for the next 3-4 months, Hero is able to compound its sales by about 5-10% every month, month on month. Not a blanket overweight, but I think given where we are over the next 6 months or so, I definitely look at nibbling into names like Eicher and Hero MotoCorp at these prices.
All right. Yes,
also keeping it with the auto stocks, I just also want to quickly get your view on the diesel car makers as well. And as we know that there will be no, at least for now, there is the talks of additional GST, additional tax on diesel vehicles have been quashed by Mr. Nitin Gadkari. But if you hear the commentary coming in, it suggests that in the gradual phase out of internal combustion vehicles, perhaps diesel cars will be the first to go out. So just quickly, if you could give us your view.
And who does it hurt the most? I mean, come to think of it, the top players, Tata, M&M, which other players are we counting here, Rahul?
So I think when you look at it from a passenger vehicle standpoint, I think auto manufacturers over the last 5 years have anyway been diversifying away from diesel and sort of increasing their production of petrol and electric vehicles or even hybrid fuels for that matter. So I think from a passenger vehicle standpoint, it's not going to be too much of a deterrent. As you guys rightly pointed out, diesel is still a very important fuel when it comes to commercial vehicle traffic. There also, I think if you look at the commentary that the gas manufacturers like Indraprastha Gas or Mahanagar Gas and the others give, there is a reasonable conversion that's happening to CNG on CNG vehicles, particularly in North India, in markets like Delhi, the NCR, the UP region, the Bihar region. So I think there is a reasonable migration. And I think if you've heard the commentary coming in from ALL, Ashok Leyland, there's a very large investment that they have made into the electric vehicles. There's a lot of private equity funding that's come into the Switch Mobility. And through their platform, Dost and Bada Dost, I think the reception of that has been reasonably strong. So I think as a fuel, it's definitely a fuel of the past. I think a lot of people are already in the process of migrating if they haven't already migrated. I think the competition is going to be between petrol, electric vehicles and CNG. And of course, a lot of it is going to be determined by the way crude prices move, because while EVs to me is still a slightly longer term play because the charging infrastructure in India is still not as vibrant as it probably already should have been. But if crude prices say would come back to about 75, we are in a pre-election year. So if you have a little bit of petrol prices cut at the pump level, the fight will be between CNG and petrol. But as far as I'm concerned, I think diesel is a fuel of the past, and I don't think manufacturers in any subsegment of auto are looking at making any major investments into this fuel at least. I think the future is hybrid, and I think all companies, either through EVs or hybrids, have either gotten private equity money or will be getting so in the not too distant future.
Right, and I know we have to let you go. I know you're out of time. My colleague Suyash had a quick question on the IT pack, perhaps.
So, sir, I was listening to one of your interviews from back in July where you, advised staying away from the IT pack. Still that opinion? Do you still hold that opinion, sir?
So this goes back to my first answer earlier this conversation. I think a lot of it is contingent on the US economy and the fact that the US economy hasn't even shown signs of slowing down. I mean, if you look at the retail sales overnight in the US, they grew by 0.6% and the expectation was a growth of just 0.2%. It grew 3x of what the market was expecting. So I think there is a concern, definitely, because if you do have a slowdown, clients' budgets will get pulled back. I think it's probably not the best time to be underweight. I'd say take a neutral stance at this point. But if further evidence does emerge that the US is going into a slowdown, I think the cutting a position from neutral to underweight is far easier than going from an overweight to underweight. So if you must make an investment in IT, I'd say probably stick with the top two names, Infi and TCS. Beyond that, I think we'll probably be getting too adventurous at this point.
All right. That's Rahul Arora from Nirmal Bang. Thanks very much, sir, for taking time out. Appreciate you joining us here on News9, and we hope to get you back very, very soon.
Thank you for having me.
Thank you. And staying on with markets, Suyash, you also have a list of top gainers and losers. Perhaps run us through stocks that were in action today.
Certainly, Shweta. So among the top gainers, as I said, auto stocks stole that frame because the top five, the top three, in the top 5 stocks, 3 were the auto stocks.
Yes.
And if you look at the top 2 stocks, they were actually In fact, Bajaj Auto and Hero MotoCorp were from
iSure, M&M, I mean three of the five top stocks from auto sector today.
Yes, and most stocks rallied about 2 to 3%. Now, Bajaj Auto had a trigger. BofA Securities has upgraded its rating from neutral to buy, has also revised the target price. Grasim, which has been in the news lately, there are talks that it's looking to foray into the paints business by the fourth quarter of FY 2024. Mahindra and Mahindra, which touched a 52-week high in today's session. Hero MotoCorp was another stock which was in the news today. If we can also move on to the top losers quickly, please.
While we move on to the top losers, and I think my colleagues are going to play up that graphic very, very quickly. I also want to quickly touch on some of the big triggers that we talked about. What stood out, I think, for me in this conversation was that, and Rahul reiterating that perhaps diesel, its time is running out, and the time is already perhaps gone.
See, that's the entire argument. No, once we have to shift at some point in time from internal combustion vehicles to electric vehicles, and in that gradual phase out, who goes first?
Right.
The argument, at least what's being put forth by the government now, is that diesel cars may be the first to go. Now, even if you look at the diesel
cars were the first to go. M&M stock touching a 52-week high. It's a bit counterintuitive to me.
They are also shifting their pack. There have been talks about their remixing their portfolio, where they'll introduce a lot more petrol cars. So perhaps that is one of the triggers that we'll see. And Mahindra and Mahindra stock has been a outperformer for some time now. And keeping it with diesel stocks, diesel vehicle makers, Shweta, if you look at the running cost of diesel cars, that was one of the reasons why a lot of us in fact preferred buying diesel cars. But in the last year or so, the cost of running has been pretty much in line with how much the petrol cars cost. Then there is concerns about the emission issues. Also, we are seeing a lot of maintenance charges that come with diesel cars, maintaining diesel cars. So it seems that the momentum will eventually shift from internal combustion to EV, but perhaps diesel could be the first to go. And talking about the losers, Shweta, Asian Paints, I just want to quickly touch upon it, if we can have that. Asian Paints, Shweta, has been under pressure for a couple of sessions now. The reason I'm talking about it is it's one of the darling stocks of most mutual fund companies, and it is down about 2.5% in the last couple of days. Now, one of the reasons why Asian Paints and most other paint stocks have taken a hit is it's because of the rising crude prices. As we know, Brent crude scaled past a $94 a barrel mark today. It's at a 10-month high. WTI crude topped the $90 a barrel mark for the very first time this year. So, petroleum being a very big component, a raw material for paint companies, the cost or the raw material cost is expected to go up and this has been a very big overhang for for paint stocks. Another reason why Asian Paints has been under pressure is that Grasim is looking to enter the paint business. So perhaps there is talks that it will steal some of the market share from Asian Paints, and there are chances of increased competition coming in from Grasim.
All right, and those of course are top gainers and losers, stocks that we are tracking, stocks that continue to be in action. And BPCL, ONGC, pressure on oil stocks this afternoon could be on the back of the fact that Brent crude has touched, in fact, and crossed the 93 per barrel mark once again.
Could be, but the relationship between crude prices and fuel prices is very complex. It's not simple that if crude prices go up, the fuel prices will go up. It's a very simplistic way of looking at it. But yeah, there is obviously some pressure, and as we know, government in the last 6 months or so has maintained fuel prices. So of course their raw material cost in the form of crude is going up, but they have not been able to pass on that additional cost to the consumers. So maybe that is one of the reasons all these oil manufacturing companies are under pressure. But then again, the relationship between crude and fuel prices is not that simple. It's not
quite
very
complex.
It's very complex.
goes through refineries. There is an advance contract, so all of that will, of course, play up. The rising crude prices internationally will only play up domestically in perhaps 4 to 5 months from now. And if the prices continue to rise, it may have an impact, but may not have a direct impact just as yet. But I think we'll move on, Suyash. Online sales during the upcoming festive season is expected to witness a 18 to 20% annual growth and touch 90,000 crore rupees this year. This, according to a report by Redseer Strategy Consultants. The firm said that the sales will be driven by 14 crore online shoppers who are expected to be transacting online at least once during the festive month. There is festive exuberance everywhere, all around us. Now, this comes, remember, on the back of a World Economic Forum report titled Chief Economist Outlook Report, which expects moderate to strong growth in South Asia, notably India, at a time when global economy continues to weaken. These are interesting times, interesting parameters there to measure rising consumption in India, South Asia, and a doom and gloom that continues to persist perhaps in rest of the part of the world. Joining us at this point is Karan Maharshi, who's an economist, back with us after a very long time. Karan, thank you so much for taking time out. I want to, actually quickly begin by asking you first. There is, of course, festive exuberance, festivities that start by next week, early next week. A lot of things will change, including consumption. What are you picking up as far as, FMCG sector and white goods is concerned? Do you think there's going to be higher consumption this time around? Because reports are saying this is going to be a better festive season as, compared to festive seasons last couple of years.
Shweta, I think retail numbers remain strong during festive seasons, and I think it is almost a given that it will be the case during this year as well. However, when I see the numbers, I remain cautious about the growth as compared to the previous year, especially given the falling private expenditure component on the demand side. What that actually means is that households are a bit skeptical as far as trying to decide whether to save or to spend. Also, rising uncertainty may have a detrimental effect on consumption, given the global slowdown story making the rounds and exports already, as we are seeing, reeling. So, commodity story is something that is of a big concern at this point in time. And the inflation number, especially food, I think for a change, we are not talking about core inflation. Now we're talking about the overall number, where food inflation is something which is actually putting a lot of pressure on the consumption appeal of households. So I think we have to be really, really cautious as we go ahead and enter the festive season. Even though consumption will remain strong, but not really sure whether it would be stronger as compared to the previous financial year.
All right, fair enough. But, looking at all the data that is coming in by the way of inflation, by the way of a demand pickup, factory output pickup, all of that pointing towards perhaps a better festive season. Also, companies anticipating and stocking and, ensuring that their inventories are at an all-time high. My colleague Krishna Kumar also joining us here in the studio. Krishna, we discussed this story earlier as well. Auto companies, white good companies preparing for what could be higher demand in days and months to come.
Right, and it's almost another way of saying traditional. We have traditional festivities happening during the course of the next 3 months, and traditional for all kinds of consumer goods, fast moving and white goods to find their highest takers. Bear in mind, for India's retail industry, for example, 30% of their year's sales come from these two festive months. So that's the kind of weightage that this time period has. And any kind of negative sentiment at this time is only extremely harmful for the year's numbers. That's why I want to ask Karan, when you talk about the festive cheer at this stage, there is festive cheer in terms of demand and the opportunity for people to go out and buy all kinds of goods. But with other factors remaining the same, do you expect the Indian festive season to sort of remain steadfast, irrespective of what happens across the world?
So, Krishna, as I was pointing out, festive season is a conspicuous consumption story, and that is something that is expected every financial year, because at this point in time, during Diwali and Dussehra, the consumption story is really strong in this country, and that's a very traditional way of looking at it. But the current story, the current macro story, is not that simple to decipher at this point in time, Krishna. And so if I give you my perspective from the inventory drawdown numbers as well as capacity utilization numbers, then we see that the inventory drawdown is actually helping manufacturers to sort of increase capacity utilization levels and start to build up or replenish the inventories as they expect demand to rise in the festive season. But the problem that I see here is that prices will be higher as compared to the previous season, and given the fact that all manufacturers and retailers are facing margin pressure, they would have no qualms in passing on the incremental prices to the end consumer. So that, in my view, would be detrimental to consumption. Even though you will still see a higher number in the festive season as compared to say Q1 of this financial year.
All right, fair enough. There's going to be pressure, but from the numbers that we've been tracking that came by the way of Suyash, quarterly results of almost all FMCG companies, we saw a higher margin, and a higher margin perhaps by the way of lowered input cost and more money being saved by FMCG players. That of course was the trend we noticed when we were covering the Q1 results for at least most of the white goods FMCG companies. That essentially means that there is enough money in the books in order to cut prices. In fact, just this morning, FMCG players announced that they will be cutting perhaps some of their margins in order to ensure higher sales.
That will be a very good news for at least the consumers, Shweta, as we know that input costs did come down, which had a positive impact on the margins of FMCG companies. But if you look at FMCG pack as a whole, no, you can't compare one company to another company. The FMCG pack in itself is very well diversified. Yes. It includes everywhere from cigarettes to your Maggi noodles.
Absolutely.
So it's a very broad category to discuss. But yeah, definitely input costs did come down significantly, and as a result we saw the profit margins going up.
Right.
But as we are seeing that the problem now is that inflation is being driven by the food, vegetable and the crude prices, which will push up commodity prices and because of that there will be margin pressures for FMCG companies going forward, and maybe we'll see that in the quarterly results which begins from October.
All right. So, Karan, from what I understand, you're not very upbeat about how much festivities will festive season bring in the economics of things, and perhaps there is going to be a substantial margin cut a lot of companies will have to take if they want to ensure better price point and want to ensure more demand in the markets. But from what I'm looking at right now and going to the broader macroeconomic picture, and this has come by the way of a World Economic Forum report, it still says that India continues to be a bright spot. Now, I've heard this statement over and over for the entire year now, 9 months, and reports on reports continue to suggest that India is a shining beacon of hope in the global gloom and doom. Do the numbers still reflect that sentiment? Because there is a pickup now in China, there is a pickup we are seeing in the US. Are we still carrying the mantle of being outperformers?
Shweta, as compared to the rest of the world, India remains a beacon of hope, and it remains the world's fastest growing major economy as far as economic performance is concerned. Now, if I connect it with the Chinese slowdown, then the American China plus one strategy is actually beneficial for India, and that is not only beneficial for the Indian macroeconomy, but also from the strategic point of view, where a lot of tactical capital market allocations have been allocated to India, given the fact that Russia is no longer part of the portfolio of global investment portfolios, and China is now sort of in a recession. Then India is actually gaining from this scenario. But the competition, Shweta, is intense from other countries in Southeast Asia, which are undertaking much more coordinated efforts as compared to India. While we get
Hanji,
some share of, yes.
Sorry, Karun. We were just talking about the import-export numbers that were also anticipated for the month of August. Now, there's been a chatter and talk, and in fact, Minister Piyush Goyal, the Commerce Minister, continue to be extremely upbeat about the import-export scenario, and he says that the exports will pick up and current account deficit will continue to perhaps narrow in months to come. Do you agree with that assessment? Do you see exports picking up in emerging markets as well as other markets around the world?
Well, as far as India is concerned, or any country which runs a deficit in its trade, whenever exports rise, imports also rise. So if you look at both the aggregate demand perspective and the aggregate supply perspective, you will see that the share of imports is actually rising faster in the equation as compared to the export share. So when they talk about export, they're being very upbeat about exports, and exports touching $1 trillion threshold in a couple of years. When as far as that goes, then they should also be concerned about the fact that imports will rise in proportion. So even if I think the government officials are upbeat about export performance of India, we will continue to see a deficit being run for quite some time until India sort of moves up the value chain and becomes a high value manufacturer in the world. But I don't think China would give up on that position.
Stay with us, because we have more numbers coming in for the month of August as far as exports imports is concerned. The numbers are out and about, and let me quickly, for the benefit of our viewers, summarize it. India's exports continue to rise. It's at a 3-month high in the month of August. Trade deficit has now narrowed. India's imports in the month of August reached $58.64 billion, while exports rose to a 3-month high, as I mentioned, to $34.48 billion, resulting in a trade deficit of $24.16 billion. Now, this was, of course, anticipated. This was expected, this was in line, and although there was not a lot of signals out there that would suggest that exports will rise, they have risen to a 3-month high, Karan. Do you think this trend is likely to continue in months to come as we see more pickup in Chinese economy particularly?
Yes, absolutely, Shweta. But the bigger story here is that we also have to look at the share of imports in the entire aggregate demand story here. So if I look at the Q1 and Q2 numbers, for example, then in the aggregate demand equation, export share has actually gone down from around 24% to around 21%. At the same time, the share of imports has gone up from 26% to over 27.5%. So it is not black and white that when we look at the export numbers and say that India's export performance is great, because India still runs a deficit,
right,
and import share in GDP as a contributor is also rising significantly, much faster than that of exports.
Right, Karan, absolute pleasure speaking to you. Thank you very much for joining us and for sharing your inputs. It's been a long time coming. We're hoping to get you back on the show, and better late than never. Thank you so much.
Thank you.
But with that, I think we'll have to wrap up the show. We have more news items coming in up next. Thank you very much for watching.
China won't let us rest easy on our borders, but they will keep flooding our markets.